organization is something that is of utmost value because it constitutes the larger portion of the volumes, not in terms of the costs, but also and how business generates revenue. So as an accountant, you must accurately measure and capture every asset in the organization, and not only capturing and accurately valuing those assets, it must be in line with the appropriate standard that IFRS has brought in place for all professional accountants to adopt. So this afternoon, these are the things that we'll be looking at very quickly. So while the training is going on, if you have questions, please, you can just put down your question. And then when we finish the class, you can ask your question so that we will not make the class very, very crowded. All right, so I'm going to share my screen now. Please confirm to me when you can all see my screen, and then I can start. Can you all see my screen?
Yes, I can see your screen.
All right, can everybody else also see my screen? Can everybody else see my screen?
I can see your screen. Yes.
Yeah,
all right.
sure, we can.
All right, so this is what an asset register looks like. An asset register comprises of everything that has to do with that asset in the business. And so your register should comprise the following. You should have the name of the company that you are handling that register for. So in this instance, let's say the name of this company is Elite Accounting Professional Services. So then you are going to have information relating to the assets. Everything, because this asset register, one of the major reasons why we keep them, aside every other important reason, one of the major reasons is such that when anybody comes, for example, an external auditor who is not, or the management or shareholders who is not really into the activities of that business, and they want to know what is actually going on in that business, this asset register should be able to pinpoint what is actually happening in that business. So information that will make every asset to be located and that will make assets to be accurately captured is what you are going to have here in your register. That's why we call it asset register. So on this template, we have so many categories of assets based on how your company is. So, you know, according to IAS 16, assets differs in terms of the company you find yourself. So what I can be calling asset in my own company might not be an asset in your own company, depending on the operations of that particular company. But when, in as much as that particular item fulfills the criteria of IAS 16, you are supposed to capture it in this place. So what are the informations that you can likely find in an asset register? You have the name of the asset, then you have the class of the asset. Then you can also have the supplier where that asset is purchased from, such that if an external auditor comes now and he sees all these things in your asset register, they are properly documented, you know. So you can also have the quantity of assets that was purchased. Okay, I think I have something here. You can also have the quantity of asset that was purchased. Maybe, for instance, you purchased an asset, maybe you went to the market, you purchased an asset, 2, 3, 4, 5 items, the same class of item, the same quantity and everything. you can accurately capture them in one folder. So you can have the quantity of the assets. You can also have what we call asset allocation. It's always good to have asset allocation in case you want to do inventory counting, in case you want to apply inventory management to the asset that you have. You want to count your inventory. You want to know whether the assets that you have in your register is still what is in existence. And in order to do that, if you have assets allocation, or what we call tag number, depending on your company, this will help you to easily locate any assets that you are looking for. So depending whether you have location code, tag number, asset allocation code, whatever, this is where you are going to put those location or asset tag code. And then you also have the location. Where is this particular asset located? Where can we find these assets? If the auditor comes or the shareholders checks your register, where can we find these assets? Is it in the office? Is it in the MD's office? Is it at the other branch? Wherever this asset is, where the asset is functioning, you are going to put it under your location. And then you have the cost of the assets, you have the total cost of the assets, and then you have date of purchase, method of depreciation, depreciation policy. For depreciation policy, so every company has their own depreciation policy. So a company can decide to depreciate their office equipment using 25%. A company can decide to use 20%. So in as much as it fits your organization policy and you are good with that, a company can say, I want to depreciate my asset for 4 years. So if you say for 4 years, that is after 4 years, you want to sell off that particular asset. So that means that you are using 25% depreciation. And what are the method of depreciation that you are using to depreciate your assets? We have different types of depreciation method. You can use straight line method, you can use reducing balance method, but in best practice, most companies usually go with the straight line method. So the method of depreciation that you are also using would also be indicated here. And then the depreciation policy will be indicated here. And then we also have every other parameters. So I'll talk more on all these parameters when we are looking at the different examples of how to do this. So I'm going to do few illustration on purchase of an asset, and I'm also going to do illustration on the disposal of an asset. And then we'll also look at the journal entries. How do we post these assets when they occur? So let's look at office equipment. So like I have categorized all of this here. We have furnitures and fittings. I'm going to do at least two examples or three examples on each of these. We have equipment, PPE, and then we have motor vehicles and the like. So depending on whichever one you are using, but whatever example we are going to do this afternoon, you can use it on all classifications. So let's assume we bought this asset. This is office equipment, let's say laptop, HP laptop or Lenovo laptop. We bought Lenovo laptop called i3. That's the particular equipment that we bought. And then the class of this asset we said is office equipment. And then the supplier where we bought this asset from, let's say we bought it from Office Land supplier. And then the tag number of this asset, you can tag this number, you can use one, you can use anything in as much as you are able to locate that asset when you are looking for it. So let's tag this asset 200. The serial number, you can tag it, say, let's say this is 200. Where is the location where we can find this asset? Let's say the accountant the accountant's office. These assets can be found in the accountant's office. And how many quantity of this asset was purchased when the asset was purchased? Let's say one of these assets was actually purchased. So what's the cost of this asset? Let's say the cost of this asset is 300,000 naira. So I have actually, this register is, I used it for, multinational companies. So everything in terms of the formulas, in terms of how to make it easy for you in a situation where you are keeping records of thousands of assets. Companies who have branches all over Nigeria, multinational companies, and all of that. Some of them have actually gone advanced beyond the using Excel to keep register. Some of them have it on their ERP system, their SAP to keep register. But just in case you don't have such platform and you find yourself in a situation where you keep assets for companies that is beyond 10 and all of that, you can actually use this kind of template to accurately value your assets. So the total asset of this asset, the total cost of this particular asset is the quantity multiplied by the cost of the asset. So I'm going to do an example also where we have a situation where we bought more than one asset. So how do we go about that? So the total asset is this multiplied by this, which will give us this amount, 300,000. And then what's the date of purchase? And this is where we are going to this is where we need to pay much attention, because if you miss it in where you value your assets, you might miss the depreciation amount, and then that will go a long way in affecting your profit. So you must accurately capture your assets. So here now, this asset, we are assuming that this asset was purchased on the 1st of January. Let's say this is 1st of January 2016. This asset was purchased 1st of January 2016. And the method of depreciation used for this asset, we are adopting a straight line method. We are adopting a straight line method. So you come here, you indicate it, the type of depreciation method that you are using, straight line method. If it is reducing balance, you indicate it that you are using reducing balance method. And what is the depreciation policy of this particular company? For Elite Accounting Professional Policy, we go for our office equipment, the policy is to use 20% rate. So we use 20% to depreciate our assets. So that means that for our office equipment, we don't want it to go beyond 5 years, useful life of 5 years. How do I know that it is 5 years? 100% divided by 20%, divided by the policy that the company has adopted. That will give you the number of years that asset is going to last. And that will also help you to determine the asset depreciation or the asset replacement policy of that company, because the useful life of the asset will determine the replacement of that particular asset. So for this company, we tend to replace all our assets every five years. So that's why we are using a depreciation rate of 20%. So whatever rate you are using here will determine the useful life. So your company might not have put in a place. Maybe you are the accountants that want to implement a policy. You can ask the management that how long do you think your plant and equipment should last before you replace it? The management can say, oh, I want it to last for 4 years. So when the management says they want your plant and machinery to last for 4 years, how do you now determine the policy? It's very simple, just swap it. So that will be 100% divided by 4. So that will give you 25%. So it means the depreciation policy that you are going to adopt in order to meet up to the replacement strategy that the company has put in place would be 25% on a straight line method. So whichever areas you find yourself, whether the policy is in place or you are the one putting up the policy in place, just make inquiry of how long the management wants that particular asset to last. Once you can determine the useful life, you can get the depreciation policy. So in this case, we are using 20%, and that means this asset would last for 5 years before the sale of that particular asset. And so now we come here. Don't forget that according to IFRS 16, IFRS 16 states that depreciation should be charged on a particular asset when the asset is available for use and not when it is ready for use. Those two things are very, very different. You are going to, according to IFRS 16, you should charge depreciation on an asset when the asset is available for use and not when it is ready for use. Now, what does that mean? It means that, for instance, now, you bought a motor vehicle, or let me use the same laptop that we are talking about. You bought a laptop, and after calculating for the cost and other incidental costs that was used to buy that particular laptop, that laptop has landed in your company. Immediately the laptop lands in your company, that laptop is available for use. And IFRS 16 says that what you should start charging depreciation on that asset. Now, that laptop might not be ready for use. Maybe you are waiting for certain configuration to be done on that laptop before you can use it. For instance, maybe you are waiting for them to install antivirus. You are waiting for them to install 1 or 2 software into the laptop before you can use it. So you have not started using the asset, but the asset has landed in your company. So that immediately that asset lands in your company, that is what's available for use. So the standard says that what you should immediately start charging depreciation, and not when the asset is ready for use. It's not until you come and install software, you come and install every other application before you can start charging depreciation. You are not going by what the standard has said. So in this case, because this training is IFRS compliant, immediately the asset lands in our book into the company, we start charging that particular asset. So the depreciation starts date. So you are going to, when did we buy this asset? We bought this asset on the 1st of January 2016. So and that was the date the asset landed in our books. So that means our depreciation start date would be what? 1st of January 2016. 1st of January 2016. That will be our depreciation start date. Now, our depreciation end date. So because of the way I have formularized this Excel template, it has automatically calculated everything I need. So because this asset is depreciated at a policy of 20%, so that means that this asset would last for 5 years.
For 5 years, that's one.
So that 5 years, so that means that it will depreciate. Let's assume we are counting it manually. So 2016, we are going to depreciate for 2016 full year. We are going to depreciate for 2017, 18, 19, and 20. That's how many years? So that's 5 years. So it means the depreciation end date for that particular asset will be on the 30th of December 2020. 30th of December 2020. That will be the depreciation end date. So that is what we have here. So these are the things that an asset register must contain. So when you come here now, what is the current month that you are depreciating this asset? The current month that we are depreciating this asset is what? Because we bought it 1st of January. So that means depreciation will start from 1st of January running till 31st of January. So the current month will be 31st of January, 31st of January 2016. That's our current month depreciation. Now, our depreciation monthly, how do we get our depreciation monthly? First of all, you need to calculate your annual depreciation on that asset. And how do you calculate your annual depreciation on that asset? Very simple. So the first thing is, let me do it manually here. Since we are charging 20%, on it, so that will be 20% multiplied by the cost of the asset. How much is the cost of this asset? We have 300,000. So 20% on that, so that will give us 60,000. So that means the annual depreciation that we are going to charge on that asset is 60,000 naira. So I'm just showing you how I arrived at this 60,000 naira here, which is what is here. So that is the 20% multiplied by the cost of the asset. You are going to have depreciation for the year. And with that, that is very simple for you to now calculate your depreciation monthly. So how do you do your depreciation monthly? It's just for you to divide the annual depreciation by 12. Since you'll be posting into your P&L account every month, if you find yourself in a situation where you prepare financial statements every month, you are expected to be posting your depreciation every month. So how do you calculate your depreciation monthly? It will be your annual depreciation divided by 12. So it means that 5,000 naira is what you are going to be posting into your P&L account every month. So that means 5,000 naira will go into our P&L account under depreciation. Now, what is the month depreciated? So the number of months that you have depreciated is what you are going to include here. So for this particular example, this is the first month that we are depreciating. We are depreciating the first month. So that means our number of months depreciation will be 1. So once I include 1 here, it automatically calculates my accumulated depreciation. So that shows that in the first month, 31st of January for that particular asset, my accumulated depreciation will be 5,000 naira. So what will be my net book value as at 31st of January 2016 for that particular asset? That will be, my net book value will be the cost of the assets, which is 300,000 minus the accumulated depreciation. So that will be 300,000 minus 5,000 naira. That gives me 295,000. So that means that at the end of 31st January, the carrying amount, what I should be seeing as the carrying amount in my financial position as at that date is 295,000 naira. So that is what I have here. I'm just showing you how I arrived at my net book value of 295,000 naira. So that's how you calculate it for the first month. Now, if you want to calculate for February, you don't need to replicate it here and be going forward. This template has been made simple such that if you are handling thousands of assets, you can actually use this same template or this asset register to calculate your depreciation monthly. So all you just need to do is that when we get to February, just come to February and increase the number of months. So you increase the number of months automatically. If I come here now and I increase this number of months to 2 months, which means that I have depreciated this asset for 2 months, January and February. Once I do that, it automatically calculates my accumulated depreciation to be 10,000 naira. So I have already put in the formula there. which is your monthly depreciation multiplied by the number of months. That's what gave me my 10,000 naira. So my monthly depreciation is 5,000 naira. That doesn't change. It is constant. That's why we call it straight line method. 5,000 naira is what I will be charging every month into my P&L account. It doesn't change. What changes is the number of months that I have actually depreciated that particular asset. So what will be the journal entry for this? What will be the journal entry? Let me give an example here. So every month now, if you are posting your depreciation, your journal entry would be, you are going to debit depreciation. You are going to debit depreciation with 5,000 naira. You debit depreciation, that is your expenses account. You debit it with 5,000 naira. And then you will now credit your accumulated depreciation with 5,000 naira. Let's assume this is for January.
Hello, I cannot hear you, sir. Hello.
Hello, can you all hear me?
Yes, we can hear you.
Yeah, we can hear you.
Okay, somebody said she can't hear me. Okay, maybe you should try to refresh your network, because I think others can hear me, if I'm not mistaken. So I hope that has been resolved. Okay, all right. So what that means is that, so for January, let me assume for January, if you are posting into your P&L account monthly, so your journal entries will be that you are going to debit your expense account, which is your depreciation account. You will debit your depreciation account. That's your GL. You debit your GL account for depreciation, and then you credit accumulated depreciation with 5,000 naira. So let's assume you go to February now. February is still the same thing you are going to do. So you change this. Let me duplicate this. So for February now, you are also going to what? You are going to debit your depreciation account with 5,000 naira, and then you credit accumulated depreciation with 5,000 naira. So automatically, your accumulated depreciation is amounting for, so as at the end of February, your accumulated depreciation would have amounted to 10,000 naira. So that is why we have this here. So you can see that on your register, your asset register, your accumulated depreciation is showing 10,000 naira as at the second month depreciated, which is as at February ending. So as you are posting your GL, as you are posting every journal entry every month, automatically your accumulated depreciation is increasing. So let's assume we now want to depreciate for the next month. We are going to do again, just increase this to 3. Once you increase this, automatically your accumulated depreciation would increase to 15,000 naira. And then what will be our net book value? Our net book value will be the cost of the assets minus your accumulated depreciation. So that will be, as at end of March, my accumulated depreciation for that asset is 285. So also your postings will also go likewise the way you did the first entry. So you are going to debit your depreciation account, and then you credit your accumulated depreciation account. So let's now assume that I have depreciated this asset for 12 months, 12 calendar years. So just increase this to 12. So you can see that it tallies with our depreciation charge for the year. So our accumulated depreciation is now 60,000 naira, and then my net book value is now 240,000 naira. So that tallies with the depreciation for the year that we have. But don't forget, there is something you need to be doing every month as you are charging those depreciation. You are expected to be increasing this current month. so that you will know the month where you are in, so that anybody that comes to look at your asset register will definitely know the number of months that you have actually depreciated. Because if the number of months that you have depreciated is showing 12 months here, and your current month depreciation where you are in is still showing 31st of January, so that means you are not updating this register every month. So you are expected, if you are preparing financials every month, you are expected to be updating your asset register every month. So you will come here, since we have depreciated for 12 months, just come here and increase and put your date to be 31st December. So that means that our current month where we are in now on this particular asset is 31st of December. And where we are still going is we are going to 31st December 2020, and we have just depreciated for 1 year. So it still remains 4 more years that we are going to depreciate that particular asset. So I will give another illustration on how you can do that. So if you have depreciated this for 24 months, that is 2 years, just increase this. Automatically, it will change. Your accumulated depreciation will change. Your net book value would also change. So this net book value is what we are going to be seeing in our financial position. So just increase the number of months, and then automatically your depreciation would continue to change. But don't forget, you must continue to post your journal entries every month. You must continue to post your depreciation figure every month, so that everything would be accurate and accurately captured. So now let's assume that we bought another equipment. Let's assume we bought another equipment. We bought another equipment, HP laptop. We bought HP laptop now. And this is the class of the asset is office equipment. And then the supplier, we bought it from one of the suppliers. Let me just use Bedu PLC. We bought this asset from Bedu PLC. And then the tag number or the asset allocation code for this particular asset, let's say this asset is 20205. That's the tag number for this asset. And where can you find this asset? Where is the location? You can say MD's office. That's the location of this asset. How many assets did you buy? We bought, let's say we bought 2. Let's say we bought 5 of these assets. And at what cost? We bought each of these assets at 250,000 naira. Now, the only time you can classify all of this together is when that asset is of the same nature, is of the same brand, is of the same nature, is of the same cost. That is when you can categorize all of them together and then depreciate together. But when they are not of the same nature, you are expected to keep it individually. Even though if they are of the same nature, but they are of different amounts, you are not expected to join them together like I did here. The reason why I am joining them together is because this asset, we bought them in batch, and they are of the same model, the same brand, the same nature, the same amount. That is why they were all bought the same date, and they landed in my books the same date. So that is why I can do this. So you classify it. So what will now be your total cost of assets? So your total cost of asset will be the cost of each of the assets multiplied by the quantity. So that we have 1,250,000 naira. So what's the date purchased? What's the date purchased for this particular asset? Let's assume this asset was purchased 31st of May. This asset was purchased 31st of May 2017, or let's say 2018. 2018. And the method we are using, of course, is still straight line method, because the particular method you adopt is the method you'll be using for all your assets. So this is 20%, the rate is 20%. Now depreciation start date. So because this asset was bought on the 31st of May, so it means our depreciation is going to start from 1st of June. So our depreciation start date will be what? 1st of June, 1st of June 2018. And then to get the depreciation end date, just putting this formula here is going to give you the end date of this particular asset. So because this asset is for 5 years, so it has automatically counted the number of years for you. So, but look at it, look at something here, something differs in this regard. So because this asset wasn't bought 1st of January, it was bought 31st of May. So that means when if depreciation should start 1st of June, we are going to is going to end, the 5 years of that asset is going to end 31st of May 2023, and not up to this particular, and not what we have here. So you can see here, so that's why we are having up to 31st. So the formula has already been set there, such that the date we are charging depreciation of that asset is going to automatically calculate the end date for you. That's why we have 31st of May 2023. So now what's the current month that we are depreciating this asset? The current month would be 30th of June, 30th of June 2018. That's the current month that we are in. So let's go to how we calculate our depreciation now. Let's go to how we are going to calculate our depreciation. So you come here, your depreciation charge. How do you get the depreciation charge for the year? First of all, calculate the depreciation charge for the year. So you come here and say the cost of the assets is equals to 20%, 20% multiplied by what's the cost of this asset now, which is 1,250,000. Now I'm going to show you something. Now, normally the depreciation charge for the year is 250,000 naira. But let's assume that this company prepares its financial statement. The accounting year end of this company is from 1st of January to 31st of December every year. So it means that the company closes his or her account 31st of December every year. So now this asset was actually bought 31st of May. And this, our depreciation is for the year. But we didn't buy this asset as at January ending or beginning. This asset was bought in the middle of the year. So that means that we are not expected to charge full year depreciation on this asset. So what you are going to do in this instance is that you are going to divide it by the number of months that you are going to charge depreciation on that asset, and then you divide it by 12. So what do I mean by that? So if we are depreciating this asset for June, July, August, September, October, November, December. So that means that asset will be charged depreciation just for 7 months. Just for 7 months is when we are expected to charge depreciation on this asset. So you come here and say, multiply by 7 divided by 12. So that would give us 145,333. Now, you don't forget that This asset, we are batching it. What we are actually calculating here is for the 5 quantity. If you want to know the individual amount that you are going to charge for this particular asset, just do this amount divided by the 5. So you will know how much each of the assets would be charged depreciation for the year. So that will be this divided by 5. So that means each of these assets, they are going to suffer depreciation of 29,166.67. That is because this asset was purchased in the middle of the year. So when the asset was purchased in the middle of the year, you are going to prorate it. You are not expected to charge a full year depreciation on that particular asset. You are supposed to prorate it. And that is what we have actually done here. That is what you have actually done here. So that means that our accumulated depreciation now would be your depreciation for the year, which is this, divided by, now we are not dividing by 12, we are dividing by 7 months because we have already prorated it. We are dividing by just 7 months. So when you do this, so it means that you are going to have 20,833.33. That will be your depreciation monthly for all of these assets that you are working on. So let's be sure. Let me show you something. So you come here and say, let me get the individual amount. So if this is this divided by 7, by 5, so that we can know how much we charge on each of the assets. So this is 29,000 plus. So that means that 29,000 is what we are going to charge for the whole 7 months for that particular asset. So what is the individual, what's the amount that we are supposed to charge for that particular asset, just one asset alone and not on the batch? So you can come here, this is your depreciation monthly. You can say your depreciation monthly divided by 5. That will give you 4,166.67. That's your depreciation charge for each of those assets, not on the 5 assets. So if you want to know whether you are truly correct with what you have done, you can just come here and say, let me multiply my depreciation monthly. Let me multiply it by 7. Is it going to give me the total amount of depreciation charge for just 7 months? So you come here and say your depreciation monthly multiplied by 7, which we have done. That will give us 29,160. So that means that you can see that we are correct with what we have here for each of those assets. So because we are doing it in batch, that is why we are having this figure. So, but I have also broken it down to make sure that if you are doing it individually, this is how it would be. So you come here. So let me erase this. So you come here and say, what's the month? How many months have you depreciated this asset now? I have only depreciated this asset for 1 month. So you put it here. So just put your 1 month here. So automatically, it calculates your accumulated depreciation for you. So you can just come here and copy out the formula. So your accumulated depreciation is your month depreciated multiplied by the monthly depreciation. So once you have your accumulated depreciation, which is what you have just depreciated for that month alone. So once you do that, your next thing is to calculate your net book value. Your net book value represents the amount that will show in your financial position. So you come here, how do you get your net book value? You can use the formula, but you can also come here and apply it individually. So your net book value is your depreciation, your cost, the cost of these assets minus your accumulated depreciation. That will give you the net book value. Sorry, okay, it's on this. The cost of this asset, which is on the total minus your accumulated depreciation. So this is your net book value. So this is what would show in your financial position. So one thing you need to note is the depreciation start date. And what does the standard say? The standard says that you should depreciate an asset. You should start charging depreciation on an asset when the asset is available for use. That's what IFRS 16 says, and not when the asset is ready for use. Because the asset immediately starts suffering wear and tear. So it's not about whether you have used the asset or not. Immediately the asset leaves the supplier's place and comes to your office, it starts depreciating. You know, there are other forms of depreciation, other things that makes an asset depreciate, wear and tear, obsolescence. These are things that you also take cognizance of. So that is why the standard take cognizance of all those factors. And that is why the standard says that you should depreciate an asset when it is available for use and not when it is ready for use. So what will be your journal posting? Your journal postings would also be your journal postings. Somebody is raising up hand. Adiola.
Yes, thank you. Sorry, I don't get how you got this 145,833. That's the depreciation for the year.
Okay, so your depreciation for the year is calculated on this. Now, this asset is bought in the middle of the year. So normally, you are not expected to charge a full year depreciation on an asset where you bought in the middle of the year. So that particular asset will be prorated. So the first example we did, we calculated a full year depreciation on that asset. And that is why the formula, or how you do that, how to calculate a full year depreciation, is to multiply your depreciation policy times the cost of the asset. So, but in this case, where we are prorating, what you are going to do is still the same process, but now you are not calculating for full 12 months. You are going to calculate for the number of months that that asset would suffer depreciation. So that will be, what I did was, I come here, I say my depreciation policy. What's my depreciation policy? My depreciation policy is 20%, which is 0.2 multiplied by what is the cost of this asset, which is the total cost of this asset is 1,250,000. Now, if I am not prorating, if I am charging a full year depreciation on this asset, this is what the full year depreciation will look like for those 5 sets of items that I bought. My full year depreciation should have been 250,000 naira. That is on the basis of the asset was purchased 1st of January 2018. So that means we are going to charge depreciation up till 31st, which is a 12-month period. So, but in this case, these assets, in this case, if you check the date of purchase for these assets, the date of purchase is 31st of May. The date of purchase for this asset is 31st of May. So you can see here, this is when we purchase the asset, 31st of May. So that means we are not charging depreciation for that accounting period, for that 12-month financial. We are not charging depreciation for January, February, March, April, and May, because the asset is not in our office. The asset is not in our book. So we are not charging depreciation for 5 months. We can only start charging depreciation when the asset landed in our premises. So that means the period we are charging depreciation is just from June, July, August, September, October, November, and December. And that is how many months? How many months period is that? That is
7 months.
7 months. Fantastic. So you are now going to prorate. So because I have calculated what I did here, because what I did here is 12 months period, you can see how I arrived at this, my 250 is a 12 months depreciation charge. But because we are dealing with 7 months, so you are going to now divide. So you can say multiply by 7/12. 7 is the number of months we are depreciating, and then 12 is the full year depreciation that we have actually calculated. So what we are saying is that I don't want 250,000 as my full year depreciation. Just give me for 7-month portion of it. Take out, just give me 7-month portion of that depreciation figure. That is what I need for that calendar year. So I do multiply by 7 divided by 12. So once you do that, that will give you 145,833. So that means that my depreciation charge for just 7 months is this figure. So once I start depreciating it monthly, as at the end of 7 months, let me come here now. Let me show you something. At the end of 7 months, now the month depreciated now, you can see the month depreciated is what shows my accumulated depreciation. Let me clear off this. Let me minimize so that you can see my screen very well. So the month depreciated now is what will form my accumulated depreciation. So if the month I have only depreciated for 1 month, that is why my monthly depreciation is showing 20,833. But let's now assume that I have depreciated for 7 months. It must give me the depreciation charge for the year, which I have calculated. That is why you have that figure there, depreciation charge, to guide you on the accumulated depreciation, because your accumulated depreciation as at that particular date must not exceed the depreciation for the year. So let's assume I depreciate for 2 months, my accumulated depreciation will increase. I depreciated for 3 months, it will increase. I now depreciated for 7 months. It must give me the depreciation charge for the year. So you can see that is why we have the depreciation charge for the year. So that means as at the end of that year, my accumulated depreciation must be equal to the depreciation charge for the year, which I have put here as a form of guidance, so that I can properly account and value my assets. So that is why so you can see that as at December 31st, 2018, my accumulated depreciation is the same as my depreciation charge for the year. So when I now go to next year, so next year now, I can now charge for full month depreciation. So so I can just say next year now, my depreciation, I will just, as I keep increasing it, it keeps on changing and changing and changing until you fully exhaust the useful life of that asset. I hope that is clear.
Yes, thank you.
All right, so that you do that, that's how you prorate an asset when they are purchased in the middle of the month or any time of the month. So your net book value is what would be showing in your statement of financial position as at 31st December 2018. As at 31st December 2018. So that is that on that. So your journal entry would also be the same, because you need to post depreciation every month. So you post depreciation every month. How do you get, because this is, you can post lump sum, because we actually did a lump sum here. So you can post lump sum. If you don't want to post lump sum, just divide this by the number of items, the quantity, you are going to get the amount to post. So, but because this particular asset is of the same nature, the same amount, same model, and same brand, you can post lump sum. So what will be your posting? Your journal entry is your journal entry would be, you debit your depreciation, which is your expense account. You debit your depreciation account with 20,833.33, and then you credit your accumulated depreciation with the same amount. So As you keep on doing that, your accumulated depreciation is increasing. Your accumulated depreciation is increasing, and then you can now, your accumulated depreciation is increasing. So when you finally exhaust this asset, your accumulated depreciation will equal the net book value of that particular asset. So that is how you treat when an asset is purchased full life, and also when an asset is purchased during the mid-month of the year. So now let me treat one vital point. So you can apply this. You can apply this to, you can come here and say, okay, let's do motor vehicle. Let's do motor vehicle, or any kind of asset that you have in the business. Let's do motor vehicle. Let me just use this same, let me use this same place so that we'll get to follow each other, and then you see. Let's assume motor vehicle was actually purchased. So motor vehicle is the asset that was purchased. What's the class of the asset? You can say the class of the asset is motor vehicle. If you have your GL separate, you can say this class of this asset is motor vehicle. And then you come here. Let me bring out this other columns because you need it. So you come here. Where did we buy this motor vehicle from? Who is the supplier? Your asset register must contain all this information. Who is the supplier? The supplier is let's say let me use one. Let's say Chinedu Enterprises. Chinedu Enterprises. This is the supplier. Now, what's the tag number for this motor vehicle? Because you need to allocate your asset with a code. Some companies have asset code, asset location code, while some use tag number. Yes, you are going to get the recording. The recording of this class will be made available on our YouTube page. So once we finish the class, I'm going to make it available on our YouTube page. So you can always go to our YouTube page anytime, any day, anywhere to listen to this training. And so you come here, tag number, let's say our motor vehicle, we tag it with 300 or 3001, whichever tag number you are using. So the purpose of this tag number is to help you identify those assets. Maybe if you are looking for the assets, you don't need to be stressing yourself. Just look for the tag number on the asset and see if it corresponds with what you have on your code, and then that's the asset you are looking for. So where is this? Where is the location of this motor vehicle? Where can we find this motor vehicle? So you will come here and say, where can we find this motor vehicle? Maybe this motor vehicle was purchased for one of our branch in Bagada. So you can come here and say Ojodu branch. You can say this asset can be found in Ojodu branch. So your auditor just immediately they pick your asset register. There's not the information that they need to verify your assets, so that they won't think you are putting up what is not there. Immediately they pick, once your asset register is in this form, immediately they pick it up, they can get the information that they need to verify your asset. You have made the work so easy for them. So what's the quantity of this asset? Let's assume the quantity of this asset is 1. And how much did you buy this motor vehicle? Let's say 3 million naira. 3 million naira was purchased. So what will be your total? Okay, 3 million naira. So what will be your total cost? Your total cost is the cost of the asset multiplied by the quantity. So you keep on, you do that. So what will be our what will be our date of purchase? When did we purchase this asset? When did we purchase this asset? We can use, let me use another date. Let me use another date. That is, let's assume the asset was purchased 1st of September. 1st of September 2020. 1st of September 2020. Our depreciation method is still straight line. We are not changing that. Now, what's the depreciation policy for motor vehicle? Your company can say, oh, I want us to, the replacement strategy, the asset replacement strategy that we have in order to keep all our assets functioning and in order to ensure that assets keeps generating revenues to the business and productivity level keeps increasing and it doesn't fall flat to meet up the demand of customers. Let's always replace our assets every 3 years. So when the management says that the policy is that they should replace assets 3 years, asset replacement strategy can help you to determine the depreciation policy that you as an accountant will put in place in your SOP. So if the company, let's assume the company is newly established, they don't have all of these things in place, and you just want to establish it. After you have confirmed that the management wants it to be replaced, maybe their strategy is to replace every motor vehicle 3 years. That means that with that 3 years, you can get your depreciation policy that will be in your SOP. How do you do that? You just come here and say, is a line showing on my screen? Something like a mark. Is it showing on my screen?
Yes, sir. A line is showing on your screen.
That was done by, who did that line? So please.
Sorry, good afternoon. It's actually done by me.
Please
Mistakenly, but I don't know how to erase it.
There's a way you can erase it from your end. If not, I can't erase it from, let me see if I can erase it here.
Okay, please do. I'll also try to erase it here.
I can't erase it from here.
I'm actually trying to, because I mistakenly click on a pen here. There is a pen showcasing on my screen.
Yes,
So
remove the mouse. Go to animate. There is like a remote control on your screen.
I'm still looking for it. No.
You can, there's a place where you can clear all drawings. Okay, don't worry, I've done it. I've erased it here.
Oh, okay, yeah. Thank you. So sorry for that.
No problem. I'm coming. Let me also. I'm coming. I want to check something. Yes. All right, we are good to go, right?
Yes, sir, we are good to go.
Okay, all right. So, like I said, this asset was purchased on the 1st of September 2020, and we are using a straight line method. Let me clean all of this. So let me minimize this so you can see my screen clearly. So that means that our depreciation, I was trying to explain something. So what you just do is 100% 100% divided by, the management says 3 years. So you can say 3 years divided by 3. That will give you how many? That will give you 33%. So that means you are going to use 33% as your depreciation policy. So you can see that we are in line with what the management wants for their business, what the management wants for their assets. So you can either use the number of years, divide 100 with the number of years, you get the policy, or you divide the policy. Or let's assume the management says that they don't know what their replacement strategy would be. And they want you to put in an asset replacement strategy in place. So you can come here and say, okay, what's the policy? What's the depreciation value that you want? What's the rate that you want us to use to depreciate our motor vehicle? If they say 20%, so that means that on a norms, it means that asset, the useful life is 5 years. So on a norms, you can say 5 years, let's use 5 years as our depreciation or as our asset replacement strategy policy. But the management can say no, and they don't want it to get to that period. They don't want it to get to the useful life of the asset before they replace the asset. That is when you will now have to do your replacement strategy. There is a template for asset replacement strategies just for you to calculate which of them will give you the asset equivalent value and the cost. If you are trying to, you can do asset replacement strategy on one asset. You can also do it on multiple assets. So that is where you now need to, you go further and calculate what we call the using the asset replacement strategy. That's another topic. That's another training on its own. And that one, you need to put in other factors in place. That is if the management says they don't want you to get to the useful life of that asset. But here now, we are assuming that the management goes with whatever we have told them. So in this case now, if the management says 3 years, then our policy will be this figure. If the management says they want our policy to be 20%, then our replacement strategy will be 5 years. That's the assumption that we are giving. So in this particular case now, let's assume our depreciation, let's use a random figure. Normally you can go with 33%, that's fine, but let's use a random figure so that we can be, will not be having, but let's go with what we have actually postulated. So we can say here will be 33%. That's what we are using for our motor vehicle. So now our depreciation start date, according to IFRS 16, we start charging depreciation on these assets on the 1st of September, immediately. 1st of September 2020. 1st of September 2020. So that means that we are charging depreciation for September, October, November, December, just 4 months. Please take note of that, 4 months. So when you come here and say, our depreciation end date will be what? So you can come here and pick the formula, but this is how I arrived at the formula. Very simple. You come here and say is equals to, you can come here and say here is equals to your start date, which is this, plus open brackets 365 days. 365 days, which represents 1 year. 365 days is 1 year. Then multiply by how many years is this, how many years is the useful life of this asset. So let's assume this is 3 years. If we go by this policy, 100 divided by 33%. So that means our assets will last for 3 years. So just say your start date multiplied by your start date plus open bracket 365 days multiplied by 3. So you come here and close bracket, then you put it. So you can see that it will automatically calculate your depreciation end date for you. So you can see it means that, so this asset we are going to finish depreciating this asset 1st of September 2023. That is a full 3 years depreciation. So in that regard, we have calculated. So our current month depreciation now will be this. This is our current month depreciation. This is where we are in. This is where we are in. So our current month depreciation is this 2020. So now what is our depreciation monthly? So to get your depreciation monthly, the first thing you need to do is first of all calculate your depreciation yearly first. That will help you to determine your depreciation monthly. Now, how do you calculate your depreciation for the year? Your depreciation for the year is the rate. What's the rate of the assets? The rate of the asset is 33%. So that will be 0.33 multiplied by the cost of the asset. What's the cost of this asset? The cost of this asset is 3 million naira. Now, this should be our depreciation for the year on a normal basis. This is a 12-month depreciation. This is a 12-month depreciation. But you would agree with me that this asset wasn't purchased as of January. This asset was purchased as of September. We cannot depreciate an asset that is not in our books. We can only depreciate an asset the day we brought that asset into our books. So that means we cannot charge a full 12-month calendar depreciation on this asset. So we are only charging 4 months, which is from September, October, November, and December. So that means these 12 months, we need to prorate it. So in prorating it, you will just say multiply by how many months are you looking to depreciate that asset for that year? It's just 4. So you will say 4 divided by 12, which is the full calendar depreciation that you have calculated. So once you do that, it gives you the accurate depreciation for that particular 4 months. So that means for the year, for 4 months, we are only going to charge 330 on that particular asset. That's the depreciation for the year. So when you now to now get our accumulated, to now get our monthly depreciation, that will now be your yearly depreciation divided by 4, because we have already broken it down now to 4 instances. So divided by 4, so it means our monthly depreciation on this particular asset is 82,500. That's our monthly depreciation. So how many months have I depreciated this asset? I'll say 1. Then what is my accumulated depreciation? My accumulated depreciation is the number of months depreciated multiplied by the monthly depreciation. That's my accumulated depreciation. So when I go to October now, I want to depreciate for October. I will come here and update my register. So that's why I said, if you prepare financial statement every month, you are expected to update your asset register every month. That will help you to properly account and value for all the assets in the book. So I come here and say, now my current month is what? October. So October, if I'm depreciating for October, that means I've depreciated for 2 months. So for 2 months now, I don't need to do anything. I just need to increase the number of months I have depreciated this asset. I increase it to 2. Automatically, it's going to increase my accumulated depreciation. So what's the posting to this? What's the posting effect to this? The first month, which is September, the journal entry you are supposed to raise is you are going to debit your depreciation account, which is your expense account, depreciation expense account, with 82,500. You are going to credit your accumulated depreciation with 82,500 for that month. When you now go to October, the same journal entry you will pass, because you will keep passing up your depreciation every year. So you are also going to debit your depreciation expense account with 82,500. That is why the monthly depreciation doesn't change. It doesn't change. but you will now credit your accumulated depreciation. You credit your accumulated depreciation. Let me do it here. You debit your depreciation expense account. Depreciation expense account. That's your GL. You debit it with 82,500, and then you also credit your accumulated depreciation with 82,500. So when you do this for September, when you do this for October, automatically your accumulated depreciation will be having the summation of what you posted into it in September, and then what you also posted into it in October. So that will be 82,500 plus 82,500. That should give us 165,000. So that is what we have here. So this register will guide your postings. So you can use this register. You can go and check, because your accumulated depreciation is supposed to have a credit balance. So you can go and check your accumulated depreciation. As at this date that I have depreciated, is the amount the same thing is with what is in my asset register? So when you go to your accumulated depreciation account, you are going to be, as at October 31st, you are going to be seeing 165,000. When you come to your asset register also, you are also going to be seeing 165,000 there. So that means that your asset register, together with your financial statement and everything in it, they are what? They are properly accounted for. So in that regard, the next thing you do is to calculate your net book value, because your depreciation is not supposed to be with your what? Your net book value in the financial statement. So how do you get your net book value? It is the cost of the assets minus the accumulated depreciation. Cost of the assets, which is this, minus your accumulated depreciation, which is this. So you have this. So you can see, if I increase this my month now to 3 months now, that is November ending. If I increase it to 3, everything is going to align because they are all formularized. So if I increase this to 3, you can see that my accumulated depreciation has increased to 247,500. Also my net book value has reduced. The carrying amount of that asset has reduced. So if I increase this to 4 now, to show the number of depreciation I'm supposed to charge in a year, if I increase it to 4, my accumulated depreciation must be equal to my depreciation charge in a year. So this is it. And then my net book value would also reduce. So as your accumulated depreciation is increasing, your net book value is reducing, because the asset is reducing in value. The asset is reducing as a result of depreciation. So that is that. So when you now come to new year, for instance, 2021, you now start depreciating. Just be increasing this to 5. Once you increase it to 5, your net book value will reduce. Once you increase it to 6, it will reduce. When you get to March, increase it to 7, it will take effect. Increase it to 8, it will take effect. So let's now assume that, these assets now, let's assume we depreciated it in full. This asset is supposed to last for 3 good years. The asset is supposed to last for 3 good years. How many months is in 3 years? How many months do we have in 3 years? That will be 36, right? So we have 36 number of months to depreciate this asset. So when you come here now, let's increase this months to 36. So you can see that 36, our net book value has reduced to, okay, so our net book value has reduced to 30,000 naira. Normally, our net book value is supposed to be 0. So now this is what you have to do. Don't forget that this is prorated. So it means that you are going to stop at the particular month wherein that asset was purchased. So let me come here, let me rectify this. 29. So you are supposed to have so the reason for this difference, is the proration. You know, we are using 33%. 33%. So 33%, when you do 3 years of 33%, that is not up to 100. Normally, you are supposed to have 100. You are supposed to have 100%. So, but 33 will give us 99. So 1%. So that 1% is the reason for this difference. That's why this 30,000 is sticking out. Normally, you are not supposed to have anything here. So if we increase, let's say we do this now to be our depreciation figure to be, let me use a whole sum, let's say 25%. So that's 4 years. Now, automatically, everything will change here. So if you prorate all now, let me not, because we'll have to go back again. We'll have to go back again. So, but the reason why you are having a difference of 30,000 is the 1% that is left on that asset. So 1% is why this net book value is sticking out. So normally when you depreciate all your assets, you are expected to have 0. You're expected to have 0 on that asset. Let's use this example. This asset, let's use this, let's go back to this our previous example on laptop. Let's assume this assets we are depreciating at 20%. So that means 5 years. So 5 years, 12 times 5. 12 times 5 is 60 months. So it means that we need 60 months to depreciate this asset. So if I come here now and say the number of months I have depreciated this asset is 60 months, my net book value must show 0. So that means you can see here, I put 60 months, my accumulated depreciation has gotten to the fullest, which is the cost of the asset, and then my net book value is 0. So at this point, when you have depreciated the asset to 0, you are going to be having, you are going to deregularize it. I mean, you are going to derecognize it from your financial statement. So it means that this particular asset should be reading 0 in your balance sheet. I want to treat one more example, which is on disposal. So let's assume now this asset that we have depreciated to 0 now, we have actually disposed it. We call it disposal, or we call it derecognition. So there are 3 forms of disposal. Disposal can occur in 3 forms. There can be a sale of disposal. There can be a situation where you depreciate the asset to the fullest, just like what we did here. When you depreciate this asset to the fullest, that asset is no longer in the book. So disposal or derecognition means that that asset is no longer in the book. We cannot see that asset in the book. That's what disposal means. So when your asset is 0, it means you have derecognized that asset from your book. So, but let's look at a situation where you sold an asset. You bought an asset, and that asset is supposed to last for 5 years. But within 2 years, you sold the asset. How do you recognize it in your book? That's the last example we are going to take. And then before we take questions. So let me come here. Now, this is what you are going to do. Let's assume this motor vehicle that we bought in 2020. Okay, let me come here. Let me use this laptop. Let me use this laptop. Now, this laptop that we bought, this Lenovo laptop, we have sold it. How do I remove it from my asset register? You will come here and say, Lenovo laptop. You put the same brand, you put the same laptop there, called i3. Now, what's the class of this asset? Office equipment. Now, where did we buy this asset that we sold? Office land. You must show the same details that you use in purchasing that asset. That's the same details you must put there, so that when the auditors are looking at the register, they will know that, yes, what you put there signifies that that asset has been sold at. What's the tag number of that asset? 200. Now, where was this asset located when it was in the business premises? Is in the accountant office. So you come here and say accountant office. Accountant office. What's the quantity of the asset? We bought one asset, so we sold one. We sold the asset, one. What's the cost of the asset? Now, this is where you are now starting your disposal, because according to IFRS 16, IFRS 16 said that when you have disposed an asset, you are supposed to remove everything pertaining to that asset from your financial statement. So it means that you are removing the accumulated depreciation, you are removing the net book value, you are removing everything, the depreciation, everything that relates to that asset, because that asset is no longer in your book. That asset is no longer in your book, so you are removing everything from it. So what do you do? How do you remove it from your asset register? You come here and put it as what? Negative. You come here and put it as negative. How much did we buy this asset then? We bought it at 300,000. So you put it as negative. Negative means that asset is no longer in the business. So what's the total cost of this asset? Total cost of this asset is the cost of the asset multiplied by 1. So that will give us negative figure. So you come here now. So let me, I've used this. So let me minimize this so that you can see other items clearly. So when you come here, what's the method of the asset? Straight line method was used. You put it here, straight line. What was the depreciation policy when the asset was in existence? 20%. You put it here. And then the depreciation start date, you put it there. When did you start depreciating these assets? We started depreciating these assets immediately the asset was brought into the business. That was 1st of January 2016. That is what we have here. Now, what is supposed to be the depreciation end date? The depreciation end date for this asset is this. So you can come here and put the formula. That's the depreciation start date plus 365 multiplied by what is the number of years? This asset is going to last for 5 years. So just say 5, and then you close bracket. So normally the depreciation end date is 31st of December 2020. So now you come here and say, what is the current month depreciation? Now let's assume that this asset was sold in, let's assume we have depreciated this asset for 2 years. Then as at 1st of January 2018, 2017, so 2018, that was when we sold this asset. So that will be what will be your current month when the asset was sold. Now, you will not come to this, your depreciation monthly. What is the depreciation monthly? You put the same 5,000 naira here that you have been depreciating. Now, how many months have you depreciated this asset before you sold it? So we bought this asset 1st of January, we sold it 1st of January 2018. How many months have we depreciated? We have depreciated the asset for good 24 months. We have depreciated the asset for good 24 months. So you come here and say, we have depreciated this asset for good 24 months. So when you depreciate that asset for good 24 months, the next thing you do is you come here. So what will be your depreciation for the year? Your depreciation for the year is the same way you calculate it. That's the cost of the assets, because it's in negative already. So whatever thing you do would be in negative to get rid of what was in the book initially. So you come here and say this multiplied by what's the policy? That's 20%. So that is what? 60,000 naira. So it means that we have depreciated this asset for 24 months, that is 2 years. And as at that point, the depreciation value, the depreciation for the year. Okay, let me say the depreciation for the year is 60,000 naira. Now, what will be your accumulated depreciation? Your accumulated depreciation is number of months.
Hello, sir. Is it supposed to be 60,000 naira for 24 months, 5,000 naira per month?
No, this is for the month. This is for the
Okay,
year.
for the year.
This is for the year. It's not. So now it is the accumulated that will now show the number of months that you have depreciated, which is for 2 years now. So you will now say the month multiplied by how many months have we done that? 24. So your accumulated depreciation will be showing 120,000. So that means that we have actually depreciated this asset 24 months, and our accumulated depreciation as at that date when the asset was disposed is 120. So in this case now, you are now going to make it. So here now you make your depreciation for the month negative because you are getting rid of depreciation also. As you have disposed the assets, you are getting rid of everything. You are getting rid of the net book value. You are getting rid of the accumulated depreciation. You are also getting rid of the depreciation in your financial statement and your P&L account. So this is negative. So once you do that, it's going to, your depreciation for the month is negative. Your accumulated depreciation is also negative. So that means that you have taken out that particular asset from your book. So what will be our net book value as at when we sold it? Because you need to know your net book value as at when you sold it so that you can be able to calculate for gain or loss on disposal. Because when you sold an asset, there is always a gain or loss on that particular disposal. You can either make a gain or you can either make a loss. So you need to know as at the 24 months, as at the 2 years that you have depreciated that asset, what is your net book value? So how do you determine your net book value? So that will be the cost of the asset, which is this, minus your accumulated depreciation. So our net book value as at when we sold this asset is 180,000. So 180,000 is our carrying amount. That's the net book value, 180,000. So that means that, let's assume we sold this asset for 250,000 naira. We sold the asset for 250,000 naira. So that means our fair value is higher than the carrying amount. So when the fair value is higher than the carrying amount, you are going to have what we call gain on disposal. But when the carrying amount is higher than the what? The fair value, you are going to have loss on disposal. So how do you post? What is the journal entry, or how do you post disposal of an asset, whether there is a gain? How do you write off everything? Now we have written it off in our asset register. It is no longer in our books because it's showing that as at the date when I dispose this asset after 2 years when that the asset used in my book, and the net book value is showing negative. It means I have written it off from my financial statement. That's why it's showing negative. So, but how do I now post it? Because this is just the register that keeps the record. But how do I post it into my software to capture all of these outflows that I have put down here? So what you do in this case is, there are 2 legs of entries that you are supposed to pass when there is a disposal of an asset. The first leg is that the assumption is, let me give this assumption, we sold this asset for 250,000 naira. What is the gain on this asset? Who can tell me the gain that we have on this asset? If we sold it for 250,000 naira, how do we calculate for the gain on the asset?
70,000.
70,000 naira. Thank you very much. How do we know it's 70,000 naira? That's the fair value
Minus the carrying value.
Thank you very much. So the fair value, which is 250,000, minus the carrying amount, which is 180,000. So what do? The journal entries that you are going to do to clear this off and post accurately in your book is to, you come here and say, the first thing is you debit. Now you are debiting your bank that received the money. You are going to debit the account that received your money, which is the 250,000. So you debit your bank, debit cash or bank with 250,000 naira. So you come here and put bank or cash, 250,000 naira with the amount that we sold it. Now you will not debit. Another thing you will debit is you are going to debit your accumulated depreciation account. Let me come here. You will debit your accumulated depreciation account. So when you debit, normally accumulated depreciation account is supposed to have a credit balance. So when you are debiting, it means you are writing off what is in the credit side. So if you have 300, if you have 300 as your credit balance in your accumulated depreciation, when you debit it with the same 300 in your accumulated depreciation, it means you have written it off. Don't forget that we have been posting journals monthly. We debit depreciation account, depreciation expense account, we credit accumulated depreciation. So all those months that we have been posting, your accumulated depreciation account is increasing. So when you now want to write it off, you are going to debit it with the lump sum amount in that accumulated depreciation account. So you come here and say debit accumulated depreciation account. Now what's the amount? The amount of your accumulated depreciation as such when you sold that asset is 120,000. So you come here and say 120,000. 120,000. So the next thing you are going to now do is you are now going to credit, you will credit gain on disposal because you made money. This gain on disposal under your chart of account or your GL, it will be under other comprehensive income. So you are going to see it under comprehensive income, but where you are to post this is under gain on disposal. So gain on disposal is what you are going to credit. So you credit gain on disposal. So what's our gain? Our gain on disposal in this case now is 70,000 naira. How did we get to 70,000 naira? The 250,000 which we sold the assets minus the carrying amount, which is the net book value of that asset. The difference is 70,000. So that 70,000 is your gain, on the asset. So you will now come here and credit the asset account because we are writing it off. We have sold it out. So we don't want to see that asset in our book anymore because we have sold it. So you are going to credit the asset account. Don't forget that normally asset is supposed to have a debit balance. You're supposed to have a debit balance on your asset. So when you are crediting an asset, it means you are reducing it. So the amount of assets that you used as the historical cost of that asset, that is what you are also going to credit. So we are crediting the asset account, which in this case now, you based on your GL, you can say this is your office equipment. So you credit your asset account or the office equipment account or that particular Lenovo, depending on how your chart of accounts is being structured. So you credit your asset account with the cost of the asset. So what's the cost of the asset when we bought this asset? When we bought this asset, what's the cost of this asset? The cost of this asset is 300,000. So when we credit it with that 300,000, we don't want to see it again. So when we credit it with that 300,000, it means we have removed it. So that is 300. So how do you know whether you are on point? So you are going to add up your what you have on your debit side and then all you have on your credit side. They must equal, and that is what you are going to post. If you add these two together, we are going to have 370,000. If you add this together also, you are going to have 370,000. So this is the journal entry that you are going to post. So This journal entry is when there is a gain on an asset, when there is a gain on disposal. Now, when you have a loss on disposal, because you can also have a loss on disposal, having a loss on disposal means that the carrying amount is higher than the fair value. So let's assume that the carrying amount of this asset is 180,000, but the fair value now, amount we sold it is now 150,000. The amount we sold it is now 150,000. The amount we sold it is now 150,000. So let's pass the same. What's the journal entry? The journal entry is still the same thing, the way you did the first one. I don't want to clean this so that you can go back to it. Gain on disposal. Let me put the edit here. Gain on disposal. This is for gain on disposal. And then, so let me do when there is a loss on disposal now. So loss on disposal. So the same thing that we have here is also what we are going to have, but something will change. So when you are posting gain, you post gain to other income. So you are crediting income. You know, income has a credit balance. So you come here and then the loss on disposal, let's assume we sold it for 150. So you are debiting your bank. You are debiting your bank. And then you are debiting your what? You are also debiting your accumulated depreciation as at when you sold it. So your accumulated depreciation as at when we sold it is still the 120,000, which is what we have here. So, but here now, we are not going to have a credit balance for gain. So we are not going to have anything here. So we are going to now have, you are going to now debit your loss on disposal. So when it is a loss, you will debit it. But when it is a gain, you will credit it. So we are debiting loss on disposal. So when it's a loss, what's the loss amount? How do you know the loss amount? The loss amount is the carrying amount minus the fair value. So that will be our carrying amount as at that date is 180,000, and then we sold it for 150,000. How much did we lose? We lose, that's 30,000 naira. So your loss on disposal will be what? 30,000 naira. So the only thing you are going to credit now is you are going to credit the asset account, just to write it off in your financial statement. So when you add up all of this, it must equate the journal entry that you are posting. That should give you 300,000, and then the assets for 300,000. So these are instances where you have, so I've been able to touch on when you purchase an asset for a full month period, a full 12 calendar period, and also when you purchase an asset for within the course of the year, when there is an addition, when you added to the asset that you have. So that shouldn't be an issue. Just need to properly and accurately account for your fixed asset. And also I've been able to touch on when there is a disposal of assets. And this is based on what IFRS 16 says. IFRS 16 says when there is a disposal or there is a derecognition of an asset, disposal, like I said, can take place, the recognition of an asset can take place in 3 forms. And there could be many other forms. Maybe when there is theft, when there is a stolen item, you can't find the asset again. The asset is no longer in the building. You don't know you don't know the whereabouts of that asset, but you just can't find it. That is theft. So because the asset is no longer in the book, you need to derecognize it. So you can also have a situation where you depreciate an asset to the fullest. When you depreciate an asset to the fullest, it means that asset is no longer existing. So you are going to derecognize it. And the other instances is where there is a sale on that asset. The same process, you derecognize it, and that is all for that. So we have come to the end of, that is the major thing that you will find. So you can use this same method on any of your assets You can use it on motor vehicle, you can use it on plant and equipment, you can use it on furniture and fittings, everything. This template will guide you on how you can properly keep your assets register accurate. So at this point, I'll give room for questions and questions before we call it a day. So if you have questions quickly, let me take some few questions before we call it a day.
I have question, please.
Okay, go ahead.
Yeah, thank you, bro, for this another addition to our knowledge. We are grateful. But it's not a question, it's just like information. I want to know, are you going to send us this the template and the video so that we can look at it again and the thing can stay?
Yes, so for the video, I'm going to make the video available on our YouTube channel. So after this class, I will share the link on our YouTube channel, on our WhatsApp platform. So you can always click on it and listen to this video. And for the template, I'll drop the templates on our WhatsApp group. So you can have it to keep your assets for your business.
Thank you so much.
All right, any other question, observation, comment?
Okay, my question is, okay, now in this case, when you did disposal of assets, the asset was not fully depreciated, like you still had many life. What in the case where the asset has been used to the 5 years, and it still has reasonable value that it was able to be sold for something?
Okay, so what you mean is you have depreciated the asset for 5 years.
Yeah, the full lifespan of the
normally
asset.
the net book value is now zero.
Zero,
But when you
yes,
now
sir.
sold it,
Yeah.
at least you were able to get something from it. Yes, so in that instance, it's still the same process. It's still the same process. In fact, it means you gain more. You gain more than what is normal. You use the asset for full life, and then you also sold it for a lucrative amount. So it's still the same thing. So what you are going to do, let me give an instance using this same analogy. So the asset is zero, right? And so normally you are just supposed to sell it and without expecting anything. But at the end of the day, you were able to sell that asset for 100,000. Very simple. So you will come here, that means there is a gain on that asset. So 100 minus 0, it means you gain 100,000 on that asset. So that's what it means. So you just come here also, increase, you put it here, you debit the amount that you received from that asset. That will be 100,000. And then you will now credit your accumulated depreciation. You credit your accumulated depreciation as at that date. So meaning that you have to come back here now. We have to come back here and increase our, let's use this illustration that we did now. So let's assume this asset has been depreciated up to 5. So for 5 years now, how many months is that?
60 months.
Years, that's 60 months. So we are going to increase this to 60 months. So when we increase this to 60 months, so you can see that our accumulated depreciation is now 300, and our net book value is showing 0. Yeah. So you come here now and say your accumulated depreciation, you will debit it with what? 300,000. You debit it with 300,000. So your gain, there is a gain on 100,000. You made gain because the fair value less carrying amount. Fair value is 100,000. Carrying amount is 0. So that's your gain. Your gain is 100,000. So you come here and put 100,000. Then you will now credit your assets. Credit it with the asset amount, which is 300,000. So once you credit it, add these two together. This will give you 400. This would also give you 400. So you are on point, even though the asset has been depreciated, but you sold it very good. So what the implication of this is that there will be a tax effect. Don't forget, on every gain on disposal, you are going to pay tax on it. You are going to pay a capital gain tax of 10%. So every disposal gain, every gain that you made, you are going to pay capital gain tax on it. So the higher your gain, the higher your capital gain tax. The lower your gain, the lower your capital gain tax. And when you make loss, you are not going to pay capital gain tax on that asset.
Okay, all right, thank you, sir. On that question now, what factors the company take to decide the estimated useful life of the asset? Like now, saying an asset will last like 3 years, meanwhile, some other company can say 5 years. What's the criteria you take to decide, okay, this is the lifespan of this asset? Or I don't know how to put the question, Sha. Is there
Yes, so
anything benchmark you are using to say, okay, this asset we have bought, like we bought a laptop now, we're going to use it for 5 years? Like, is it the brand of the laptop, or I don't
yes,
like
so
something like that?
you can put in a lot of factors. You can use the brand of the laptop and the quality of the laptop you bought. So you can, for instance, HP laptop, you all know that HP laptop is very good. You bought an HP laptop, brand new one, with a Core I, the latest software or window, Core, maybe let's say Core i10 or Core i7, and you bought it at an exorbitant price. So something of, and where you bought it, you know that these people, they deal with quality products. So something of such, you can estimate that, wow, with the amount that I use in buying this asset and the quality, it should take me 5 years. It should take me 5 years. So, but when you buy it, when you buy an asset that you buy, for instance, you buy what's it called now, a Y laptop, or you buy one laptop that is not okay, you bought it fairly used at an amount that is very cheap, and you are not expecting that asset to, if you, of course, maintenance is very, very key also. If you know that you can maintain such an asset to the useful life that you have actually put in place, is good. But when you look at all those factors, you now put 5 years. If it doesn't get to that year, whatever year that the asset gets to, you have to adjust your asset register. So the useful life is just like a guide. It's like an estimate, and say, okay, due to the, don't forget that the quality of your asset is what will determine your output. So because I don't want my output, I don't want my productivity to go down. I want my productivity to be high always. I don't want it to exceed this period. So, but the longer your asset, the longer the obsolete of that asset, and the lower the efficiency and the productivity of that asset. But when you don't want it to reach that period, you can put a benchmark. So, but if you put an estimated amount, you say for laptop now, you say 10 years, there is every probability that that laptop might not get to 10 years before you sell it. So if it gets to 4 years before you sold it, you are going to adjust that your asset register to the 4 years that you have sold it. So it's just like a guide. It's not, it is you that put that policy, you can also change it. So policy can be changed all the time. A company can change their policy once they discover that they are not meeting up to that criteria.
Okay, thank you, sir.
Okay, good afternoon, sir.
Yeah, good
Thank you very
afternoon.
much for thank you very much for the lecture, sir. My name is Daniel. I want to ask your advice on a situation whereby you enter a company or an establishment and then they don't have a receipt for their assets. Because I've asked before, I'm a copper serving somewhere, so I've asked them so we can put up a register, but they seem not to have receipts for most of their stuff, their computers and the rest of them. So what would be your advice, or what can I do? Thank you.
Thank you very much. So in that instance, there is actually nothing you can do. But at least if you dig down your findings very well, there must be something, there must be an evidence that shows when that asset was actually purchased. But if at all there is no evidence that that asset was actually purchased so and so date and at so and so amount, the implication of that is that auditors might not certify your books. You know, auditors will not be able to say your financial statement is showing a true and fair position, because asset is very, very key. Asset is a key component in the financial statement. So some people can lie Some companies can lie and say we bought this asset for 10 million naira. Where is the evidence? Where is the receipt? No evidence, no receipt. Even you as an accountant, they will look at you when auditors come and they want to come and audit your book. Auditors they will never say your book is showing a true, because that amount is material in your financial statement. 10 million naira is material for you to tell me you don't have the receipt. So if I'm not able to get the receipt, I can't certify that your book is okay. So the implication of it is that you might not get an auditor that will certify a true and fair view on the financial statement. But pending when the auditor will come, since they say they don't have any book, you can just go with word of mouth. But that word of mouth cannot be used to verify, because an auditor will verify all the assets and the amount that you actually claim that they have. If they can't verify that, then they cannot show that your assets is, or your financial statement shows a true and fair view. But for the meantime, you can go with the word of mouth. They will just be having the management account, but they would not have an audited account, except they went to go and bribe or talk to one auditor to just certify and let the auditor just say,
Okay, good afternoon.
do their work. But on a normal basis, they would verify.
All right, sir. I
Good
still have a
afternoon.
follow-up.
Please, can I say first?
Sir, from what you
Okay.
just explained now, yeah, like when I joined the establishment, like you just explained now, I kind of asked them. They showed me some audited account by an auditor, and while we were trying to impute our expenses, because I joined them in May, I was posted there May, so I tried to look at the expenses from January because they don't have any internal accountant. So I discovered that they are having some figures that is very high. Like we have less than 10 staff there, and you are seeing 700 and something thousand naira as salary for the month. So I was trying to ask them who and who received this salary that you paid, and they're not able to show the staffs. But you see audited account well sealed and stamped by auditor. So I was kind of worried. Are they using? I have asked them before. Are you using the projected value, or you're actually putting actual value in your account? Because the figures I'm seeing, which is being audited by an accountant, is high, very high, and I don't understand if they are doing some stuff there that just to put off an account statement or to put off an audited account statement. So I don't actually. I've been confused for some time now.
Yeah. So these are the challenges that we professional accountants will face. And a lot of people cook books. A lot of people do creative accounting. And, you just see people maneuvering and trying to put some figures where they are not. So in that regard, you can ask for their payroll. Ask them to give you their payroll, because there can be some ghost worker in such organization. It could be somebody that is perpetrating stealing in that place. If you have 10 staff and a particular staff is, that they are earning 50,000 naira, times 10 will give us 500. But when I check,
Yes, sir.
when I see your payment, I have seen 70,000 naira, and you are telling me those are the 10 staff you have. Definitely somebody is actually using somebody's name to pay and claiming that that person is actually a staff. Meanwhile, the person is not a staff. And at the end of the day, the person goes back to get those funds. So ask for their payroll sheet and see their payroll sheet, because they will have a schedule where they used to pay people. Let me see your salary, and does the amount that you pay, does it tally with that? If it doesn't tally, then you need to flag it as an accountant. Something is actually fishy in that. And we also have a situation where some auditors, as a result of some auditors don't do their due diligence. And and when an auditor don't do their due diligence, they become liable when there is an issue tomorrow. So that's why such an auditor who doesn't verify accurately, and then that auditor goes ahead to stamp and sign and seal an account without doing proper delegation, you can be held liable at the end of the day. So there can be one or two auditors that they know, based on the auditor know the managing director or know the CEO connection and all of that. or maybe the auditor
Yeah.
is also a brother to this. It's something that they will just close, and the person will just lie and all of that. So a lot of this manipulation go in the corporate world. You see things, but the implication is that if that account is being flagged, if a true, because when you submit, let's assume the company is a PLC now. The company is a PLC where you file your account with tech and every other regulatory body, and they come to do their due diligence. They come to your office. It's just that Nigeria is a system where a lot of things don't work the way they are supposed to be. There is no adequate checks and balance. If there is an adequate checks and balance, and we also have, apart from the auditor, we also have an external auditor or somebody else that comes to the company to verify. And most of these things, you see it in businesses that unlimited liability, or businesses that are not listed, because there is no, but a corporate company that is listed and they are backed up by strong corporate governance, it is difficult for them to do such. But some other companies, apply creative accounting to just make their book look good. Meanwhile, is not really good. So it's a dicey situation, but whatever you do, if you find yourself in such situation, make sure you document all your observations, and make sure you are not part of such people. Make sure that you have given them the necessary recommendation, because as an accountant, you also advise. Make sure you document all your advice, because that can also put the accountant into trouble if the accountant is seen to be part of those people. But in order to show that you are not, document every evidence. Document the fact that you have told them to do the right thing, to bring this, and they are not able to do that, because that can also affect your own career as an accountant. So you need to be wise when you find yourself in such place. You can seek opinion from your top colleagues on how to go about such instance.
Thank you so much,
All
sir.
right.
Thank you.
Please, can I make a contribution to as regards the non-availability of?
Yes, you can go ahead.
Okay, my name is Matthew. I'm watching from Asaba.
Okay.
Our colleague just asked a question as where the company does not have a supporting document or receipt for their asset. Of course, most of the company, especially the small size company, they don't often keep their receipt. But one of the advice we've gotten from our senior colleague is, in a such situation, what you're expected to do is find out who is the supplier of those assets. As we, in the case of this laptop now, find out who supplied this laptop or the asset in particular to the company, and then try as much as possible to reach out to the supplier. Ask them how much they sold the particular asset to the company as at that particular point in time. And then please negotiate with them so that they can give you a written evidence. Let them put their signature, if possible, stamp that, okay, we sold this particular asset to you, Mr. So and so, or social company at this point in time at the cost of this amount. With that, the auditor will certify it when they come. So that is one of the advice they've given to us, because if you don't have any written document to support the purchase of that asset, no auditor will satisfy that record. Secondly, one of the reasons why you see that some company will inflate or increase their personnel costs is possibly they might try to reduce their tax liability, which might have implications, just as the facilitator rightly said. But you need to know what these guys are up to, and then you know what to advise them on. Because sometimes, because the company want to pay less tax liability, they will look for possible ways they will increase the expenses and then reduce their profit line. So that is another thing that the auditor might assist them to do. All you need to do is to find out what they are trying to do, what is the bottom line of what they are showing in the financial. Thank you. This is my little contribution.
Thank you very much, Mr.
Thank you
Matthew.
so much, Matthew.
Thank you so much.
Welcome,
Okay,
sir.
Mayowa, you are raising up your hand. Let's take your question before we call it a day.
Yeah, good evening, everyone. Thank you for the training. It's really worth it because many of us, most of us, we used to hear this thing and we don't actually know how it works. So my question is, seeing this fixed assets register, and I used to hear fixed asset schedule. I just want to know what is the difference between the two of them.
It's the same thing. You can use it interchangeably. Some people will call it, some people will say fixed asset register, some people will say asset register, some people will say fixed asset schedule. It's the same thing.
Okay. Thank you very much. Secondly, if we have a gain on assets, as we have already computed before, if we have a gain on assets, and if we are filing on a tax format, is it maybe we have a gain on, and we sold an asset this month, and maybe we want to do our monthly filing, maybe the VAT and the withholding. Is there any way on the tax format where we can file for gain on asset, or we wait to the annual filing to do that? I just want to know because I've been having a lot of questions about that.
Yes, so I don't think there is another portal where you file, it's not on tax rumors. There is another portal for capital gain, so I think you'll be giving or granted access to that by FIRS. So, but I don't think there is, on tax rumors, there is capital gain, but if there is, you will just, if you are filing monthly, it's good to file monthly so that you will not be accumulating your tax responsibility. So if you are filing monthly, just put the gain. All you just need to put the gain of the asset. That is what you have to pay the 10% of. The system will automatically calculate the 10% on the gain of that asset. So, but I don't think on tax promos, because majorly tax promos is for CIT, VAT, withholding, and some other kind of tax. But I doubt if capital gain tax is on it. I think it's a different platform that FIRS used for capital gain. But nevertheless, just put the amount of gain. So, but they are going to verify. There will be some supporting document also that you are also going to include to show them that, okay, this is actually what was bought, and then what was sold. So when FIRS come, because all your records, all the filings that you are doing, the FIRS, they have the records. So when they come for tax audit, they are going to ask you to provide evidence. If there are no opportunity for you to provide those evidence on the portal, when they come for tax audit, they are going to ask you to provide evidence of this capital gain to show that yes, this is truly you are paying the right amount as capital gain. So you provide all of these evidence for them.
Okay, thank you. Please, sorry, one more. Let's say in a company, maybe in a big company, and you happen to buy a fan, maybe all this standing fan, and basically that fan is going to last more than a year, but the cost of the fan is just 15,000 or 12,000. Can we still add it as part of our asset, or we should just expense it off?
No, expense it off.
Okay.
What's the nature of business of such company?
Maybe manufacturing company. They just bought a fan for the admin.
So that's why we need to follow what IAS 16 say about an asset. If you check what IAS 16 says, IAS 16 says, and you should classify an asset when that particular thing is able to generate economic value to the business. So economic value to the business means generating, that thing is like a support system to the revenue generation of that business. So if that thing is not generating, is not supporting the generation of revenue for that business, it cannot be classified as an asset. So first thing you look at is what is the operation of that business? What do they do? If it's a manufacturing company, most of the things you see as their assets are the machineries, things that they use in transforming raw materials to finished product. So when you buy fan, so to classify an asset is not really the cost. If that cost, if it doesn't fulfill what an asset is, based on what the standard has said, it is advised you expense it. It is advised you expense such an asset. So it's not majorly on the amount you use in buying the asset. Does it fulfill the requirement of IAS 16? Because if it doesn't, at that point, it's a wrong classification.
Okay. Thank you very much.
All right. Thank you very much, everyone. So we have come to the end of this training. This is Elite Accounting Professional Service. We are involved in practical accounting trainings that is going to build your skill as a professional accountant. Trainings that you can valuable add it to your CV. You know, so these are things that we do. We do practical training, and then we also do ICANN lectures, and we do other activities. So if you are in our group, you will tend to see what we do in our group. So I'm going to drop my number for those of us that are not in our WhatsApp group page. If you are attending this training and you are not in our WhatsApp group page, I'll drop my number in the chat box. So you can chat me up so I can add you to our WhatsApp group page, and then you see all of our activities that we do. Next month, we are having a practical training on QuickBook. So if you are much interested in how to use QuickBook software at your place of work, you know, these are values that you hardly see it anywhere. These are practical trainings, are trainings you hardly see anywhere, but we have decided that we want to ensure that we build professional capacity. We want to make this a learning center where you can come and build up your skills, because majority of us might not have an opportunity to work in an audit firm or to work in a place where we are exposed to things like this. And so, but we don't want that to be like a stigma to you to learn or practice as an accountant. That is why we are bringing up all of this training. And by August, hopefully, we are going to have a batch 2, because we have done the first batch on management account preparation, how to prepare management accounts from the scratch. You know, so these are a lot more. These are trainings that we are going to be having. So thank you very much for being a partaker of this, and I hope this training has added 1 or 2 values to ourselves as a professional accountant. So we'll see you in our next training. Thank you and bye for now.
Thank you, sir.
Thank you so much, sir.
You're welcome.
Thank you, sir.
You're welcome. You're welcome.
Thank you, sir.